From month to month, even week to week. The landscape of the housing market we're investing in is ever changing. And with all the noise going on in the media, I understand how overwhelming that could feel. But fret not, that's why I'm here, and I am going to be highlighting for you all the economic data points that were released this particular week and what that means for the housing market moving forward. Starting off the week is Monday. The main thing that was released was the consumer spending report. We're seeing signs of consumer spending finally starting to slow. Like, gosh dang it. People were shopping like crazy for the longest time despite all these recessionary fears. But anyway, tax refunds are down about $600 on average, which may be impacting these numbers too. But all that said, it's a sign that the economic activity is finally starting to slow down, which could help to ease inflation. Now, moving forward to Tuesday, the Case-Shiller and FHFA's new home price index was released. Now, home prices are continuing on the upward trend, which continues to really point to the fact that we are in such an undersupplied market environment. We keep breaking new records every month. Now, fast forward to Wednesday. The US GDP growth saw a 3.2% annualized pace. Now, that was actually lower than the previous reading, but in summary, the GDP growth is showing slight decline, which is impacting, of course, people's general sentiment around how well or how good the economy is doing. Now, we finally get to Thursday when the much anticipated PCE, or the Personal Consumption Expenditure Report, which is a good sign of where inflation is in our economy. And this is actually the Fed's favorite sign or signal of where exactly inflation might be. And they're going to base a lot of their decisions on what to do moving forward based off this type of reporting. The PCE came back at the market's expectations. So headline or all-in inflation rose 0.3% month over month. Year over year, inflation fell from 2.6% to 2.4%, nearing closer and closer towards that Fed target of 2% that they're trying to hit. So thankfully, compared to the start of the week, the rates did trend down slightly. Now, currently, 30-year fixed averages are around 7.08%. Now, next week is jobs week. Lots of economic reports coming out, all surrounding the job market. And remember, the job market is actually the main culprit to why the rates corrected up from the 6.6% rates that we saw just a little over a month ago. So Wednesday of next week, we're going to get the ADP employment report. Thursday, initial jobless claims, and then Friday, the dreaded BLS jobs report. So I'll follow up next week on Friday to talk more details about the jobs numbers that come out and what the Feds may do next based on that reporting.